Hey guys, so in the last lecture, we have discussed various financial analysis techniques, that is payback period, return on investment, net present value, internal rate of return, and cash flows. So, payback period is the time in which our investment will be returned. So, that is after 4 years, after 5 years, our investment will be returned 100%. That is called payback period. Then discounted payback period, that if the value of time is involved in that the amount we are giving today will have more value in future. So by calculating the also the rate of interest in that, and the payback period is calculated, then that is called discounted payback period. Then is return on investment, that how much we are getting in returns in how much we are investing. There is return on investment, that then it is net present value, NPV, and then it is internal rate of return, that is rate of return when NPV is equal to 0. So today we are going to discuss risk and sensitivity analysis. So what is risk, and what are the factors which we need to calculate, or we need to take into consideration before analyzing any project. So what is risk? So risk we can call as a chance of making the loss. Okay, so that is risk. So if we are adopting any project, so what are the probability of chances that we will fail in that project? So that is risk. So for any project we need to make some assumptions, so which will predict the future. So based on that assumptions, the outcomes can be assumed or measured. So which assumptions? So assumption can have significant effect on outcome, so assumption should be very realistic. So if assumption can also lead to the failure of the project. So the degree of making the loss or damage to the project is termed as a risk. So that degree is called risk. And what is sensitivity analysis? So sensitivity analysis is that the measurement of change in output with respect to change in assumption. So suppose we have taken some assumption, and the things doesn't go well in our assumption, then the deviation in real life from our assumption is if it is a smaller bit, then what is the outcome of that smaller deviation. So we need to calculate the outcome based uh, deviation from our assumption. So that is called sensitivity analysis. So it measures the impact of change in any input data on the output. In other words, we can also call this what if. So what if this happens and what if that happens? So that analysis also we need to do, because we cannot take all the assumptions into consideration while selecting the project. So we need to do sensitivity analysis by considering one assumption. So sensitivity analysis measures that what will happen if this is changed and what will have the impact on output. So it is possible to find out of particular variable by keeping output as target for achieving. So there are total two factors, that is macro factor and micro factors, so which will affect our project. So we will go one by one. So macro factors. So macro factors are factors which are related to the overall industry of the firm. That is, that factor will affect whole industry, not only our industry, all the industries. So so these factors are not related to particular firm. There is no control of management on such kind of factors. So which are the factors? There is taxation policy. So if government has decided to increase the GST on certain products and to reduce the GST on certain product, so it is not on our hand. And also inflation. So if the prices of the raw materials has been increased due to inflation, the prices of the crude oil, the petrol is increased, the transportation charges is increased. So inflation, if due to inflation, uh, the product uh, cost can be increased. So that is also not in our hand. So taxation policy and inflation. Then second is political issues. So due to change in government or due to some kind of strike, so as if now this farmers strike is going on, so due to some political issues, uh, if uh, the whole industry or firm is getting some of problems, so that is also not in our hand, political issues. Then technology changes. So if our technology has been outdated due to some or the other reason, is going to be obsolete, and some new technology with uh, cheap or low cost material is being used, then so that can also create some problem. So that is also a macro factor. Then changes in government policy. So if government is thinking to increase the use of electric vehicles, or tomorrow if government is thinking to increase the use of ethanol based vehicles, that is E20. So if government changes their policy, so and that also can affect various factors. Then changes in fiscal policy like interest rates, tax rates, so that also we will discussed. Then safety policy of central government. So if government has uh, given strict rules or to safety policy, that we need to sanitize each and every person, and we need to clean each and every equipment, doors. So if the safety concern is more increased, so it may also give rise to cost to the company, that to because due to change in safety policy of the government, so we need to check the temperature, and everything is more safe, so that also can incur the cost. Then unwanted natural event. So unwanted natural event can be considered as COVID-19, so due to which there was very less business due to lockdown and all. So these all are the major factors which can harm the whichever project you choose. So these factors uh, will affect your project irrespective of what project you have chosen mainly. So it will affect each and every project in very vast way because it is macro factor. So this may not depend on selective project, given some exceptions. So now we are going to see minor factors. So minor factor includes the variable expenditure, So that is a variable expenditure means generally means a raw cost of raw material which is variable. Then change in capital structure. So whatever the money which we are having, so if that is changed, so that structure was changed. Like if we were getting money from loans, then if we are changing the structure, so that then change in capital cost of the project. So if the cost of the project is changed, so these are minor factors. Change in company's policy of purchase or sale. So if company is thinking to change its purchase and sales policy, like the if we are thinking to reduce or increase our margin, then that is company's policy. The change in length of project, if the length of project has been increased or reduced due to some reason, so this all are the minor factors which may affect the project. So this type of analysis you need to do before selecting a project. So this is called risk and sensitivity analysis. So what degree your project will fail. So the next topic is financing option. So what is financing options? So through which sources of finance, which are the available sources of finance through which we can raise some money for the company, to run the company, to increase the company, to develop or to start the company. So what all are the financing options available in the market? So we will generally differentiate all the financing options into three categories. It is long term, medium term, and short term. So the most so the long term finance. So long term finance is generally for 5 to 10 years, and it is most probably for the starting of new business, okay, or starting a new venture. uh, that is, it may be like to purchase land, machine equipments, or any hardcore working material. So this is called initial finance. Then second is medium term. So medium term is generally 1 to 5 years. And the reason behind it may be extensive marketing campaign, or sometime in order to start a new variety of the product line to new market, or it may be some tasks are left in the initially decided to start in later stage of the business. So that is medium term financial need. Then short term financial need. So short term financial need may be a fund is required for less than a year of time. So this is generally for managing the working capital or to meet any unexpected expenses in the business. So if we are purchasing the raw material from one side, and on the other side we are selling the our product, so in this between, if we have to pay to the supplier, so in between if there is a requirement of money, in that case short term financial need is required. So there's a list, there's a table, so here, in which the solution to get finance can be solved by uh, various tools, or equip various mechanisms which are created through which you can get money. So we will discuss one by one of long term finance options, and the same can be used for medium and short term also. So, long term. So, first is equity financing. So, what is equity financing? So, it is a long term finance where the ownership is offered to the public investors. So, that can be listing of your company or selling of your shares. So, the directors of the firm come with business ideas and models in the market through public issues, that is called IPO. You generally seen various companies issuing IPOs as initial public offering to invite public in their business. So understanding the inherent risk, public take their equity financing. That is, they pay money and they in return they get shares. So based on the contribution of the investors and purchasing of the shares, they are shared profit of the project in terms of dividend in case cash flows is available, profit after tax. So that is, the investor can also enjoy the dividend that company is giving. The when there is an initial huge need of fund, this is most preferable source of fund. This is because uh, this is very much good source, and as public generally has money to offer for the businesses. So further equity finances financing includes right issues and bonus issues to the investors as a tool of investment. Then next source is debt financing. So debt financing is also a major source of finance for the new project. In debt finance, debentures are issued in different denominations at different interest rates. So investors in debentures are paid certain fixed percentage of interest. So investors are not becoming the owner of the business. So there is no dilution of the control. So generally, debentures are preferred as more easy way to get finance, although it is a burden to the company. Okay, so this is a burden because we need to return it. Also in debentures, the interest is considered as an expense compared to profit after tax. So in debentures, we need to give the interest. So therefore, so it is considered as a burden to the company. So there are various types of debentures available in the financial market. So this is that is the reason why it is called debt financing. Then preference shares. So this instrument is the combination of the first two, that is equity and debt. So in equity finance, the investor enjoys the ownership, right? But no certain fixed amount of return. That is, the investor who purchases the share has no guarantee that he will get some return. Okay, while in case of debenture, the investor is enjoying certain amount of fixed return. That is, the investor will enjoy the interest on which he has given the money, but he is not enjoying the ownership. So this type of share facilitates the investor both kind of benefits, although the return provided to them is less compared to the debenture holders, but they have right of the ownership of the firm and invested amount from the firm point of view. On providing ownership in the firm, the heavy interest of the fund is reduced. So the kind of preference is more preferred by both investors as well as firm directors. So preference shares are used for both long term as well as medium term finance option. That is, Here in medium term also it is used. So here in medium term also debentures and bonds are mentioned. So there is debentures and bonds. The next financing option is uh, venture capital. So next financing option is, financial institutions. So financial institutions like uh, that is banks. So major source of finance for the project can be provided by the banks. So these institutions are providing funds to entrepreneurs based on their strength and business model. So the most difficult part is to satisfy them in terms of business model, in terms of technical, economical, commercial, managerial ability of your proposed management, marketing, and every aspect of the business. So based on reviewing all the facts, the business authority provides the fund. Okay, so this is also major make and break situation, that if any company doesn't give back the money, so the it becomes NPA, and NPA becomes headache for the financial institutions, because if they are not giving back money, so it is write off, and it is giving problem to the company, to the institutions. So it weakens the institution if the right decision is not taken. So this is also a financial option which can be taken. Then it is when so it can be used as medium term also. Okay, so medium term. Then venture capital. So it is financing tool in which financing is done by the qualified entrepreneurs, where there is idea and model of the business with the new entrepreneurs but lack the business expertise. So venture capitalists that are qualified entrepreneurs, they make investment through either debt of equity and provides the fund. So the concept of venture finance is increasing day by day, because venture capitalist is itself wants to take high risk and high return on the business. So it is easy to get fund from venture capitalists than from the financial institutions, because they know that what will work and what will not in the market. So they believe more on concept of the idea than the business model, while financial institutions believe more on the business model of profit and main on break even. Then the next is loan against assets. So this kind of funding, that is the owner of the assets, he can get loan, that is he can keep that asset on mortgage and get whatever loan he wants. So this is also a kind of finance which we generally anybody can take. Then is bridge finance. So what is bridge finance? So it refers to loan taken by firm normally from bank for certain period against pending disbursement of the section loans. That is, if there is a delay in uh, disbursement of certain loan, so till that delay that the company gets loan, so they bridge that gap and give the bridge finance. It is normally secured by hypothetic movable assets, personal guarantees, and demand promissory notes. So this is called bridge finance, that creates the bridge. Then it is international funds. It is apart from domestic. International funds like euro issues, foreign currency loans. Although this funding from agencies require high legal complexity. It is lengthy and time consuming. Then lease finance. So lease finance is a contractual agreement. Lease means, uh, and we call that is a bhade apu. That is, if we give something on lease. So is a contractual agreement that owner, lesser, that is called lesser. uh, if it is having an asset, it gives on lease, that is to other party in exchange of periodic payments for a specific period of time. That is, if any tenant gives his house on rent, it is if owner gives a house on rent on any tenant, so that is called lease. So that is called lease finance, in which return every month the owner gets some kind of money in return. So it is lease finance and loan. The loan we can get from banks. Then it is self finance. So in order to make energy management self financing, the savings in the money is split between interested parties who provides the returns. So if if people working in the company, then mean if they're giving finance directly to their company, so it's called self finance. So these are the main financing options which are available in the market. So we can access anyone, and this is a very good concept of how we can get the money. So we'll discuss, so in next lecture, that is APCO, that is energy performance contracts. So thank you very much.